Today, I would like to take a look at removing redundancies from your trading system. Now, when you've got a trading system, it is a good idea to make your system as simple as possible. Making a trading system simple is going to involve removing some of the indicators. If you've got too many different indicators, you get a lot of clutter, and that clutter can become a little bit overwhelming. And some of those additional indicators, what they're going to do is start providing you with conflicting signals. We want the indicators that we do have to give us very specific types of information, and we don't want those conflicting signals. We want everything to be aligned in such a way when we get a signal to go long, that everything is pointing in that direction. When we get a signal to go short, again, everything points in that direction. Now, over the course of the last few months, I've put out quite a few different videos, and I've been showing some examples of different ways that you can approach the market. And at the top, I've got a set of moving averages, and underneath I've got some different methods for looking at, which is this stochastic. And then we've got an RSI and a MACD, and these longer versions of these, the 50 RSI and the 2150 MACD, these give us ideas of the trend. Now, I'm going to take what I've got here because this is something that somebody had emailed me. And we're going to take what's here and reduce it. We're going to boil it down and make some changes so that we are getting rid of a lot of the additional or redundant indicators and making some changes so that some of the indicators that are here are going to be more useful than they currently are. Now, we're going to start with these moving averages at the top. So I'm going to reduce these oscillators just a little bit. We've got a 13 EMA, we've got a 100 EMA, and we've got a 200 EMA. These are moving averages that I have used in different videos. But when you see me use them in the videos, they're there for a very specific reason, and I use them for very specific purposes. What I'm getting are traders trying to take everything that I'm putting out there and jam everything into one trading system, and that's going to make things a little bit awkward and not quite as useful. Now, if we take a look at these moving averages, the 13, got no problem with the 13 EMA. The 100 and the 200, I don't have any problem with those either. But when you put the 100 and the 200 EMAs on the same chart, you've essentially got the same indicator. Now, they are separated a little bit, and you do have a gap between the 100 and the 200. But objectively, though, they are giving us the same kind of information. When we have the 13 above the 100, it is telling us that the market's long. We have the 13 above the 200. We're getting that same information. Now, what I want to do is take one of these and change the setting. Now, I've got a 13, which is great. That's a really short-term moving average that the market is going to respect. We've got a 200, which is about as long-term as a moving average as I like to go. What I want to do is take this 100 and reduce that. I'm going to cut that in half to about a 50. So what I've got now is a 50 EMA with a 200 EMA. And what I'm looking at are very specific differences now. I've got a trend on the current time frame with this 13 and the 50, and because the 13 and the 50 gives me about a 4-to-1 ratio, that 50 and the 200 gives me a trend on the next higher time frame. So if we're looking at the 1 hour time frame right now, the trend that I'm looking at is the 13 and the 50. The trend on the next higher time frame, or the trend on the 4 hour, is going to be this 50 and the 200. So I can see with these moving averages, just by making this one adjustment, I can see the current trend on two different time frames. When I have all moving averages in order, we've got a strong trend either up or down. In this case, in the middle of the chart, we've got this really strong downtrend. When we've got the red in between the two different moving averages, we've got this sideways trend that maybe isn't so strong because we have two different time frames telling us two different things. Again, we pick up a stronger downtrend as they all orient themselves. So I'm looking at these moving averages as a way to look at two different time frames trends. Now, with that being the case, with that being that I am looking at trends, I'm going to now take a look at some of these other oscillating indicators. We've got an RSI at a 50 period. That is a trend setting for the RSI. When we use an RSI, we generally want to go 5, 8, 13, 14, something like that. That's going to give us some better ideas of overextended markets or give us some trading signals. And when we use a 50 RSI, that does create a really nice trend indicator. It does tell us what direction the trend is. But with these moving averages, I've already got that. I know what the short-term trend is with the 13 and the 50. I know what the long-term trend is with the 50 and the 200. I do not need to repeat that with that RSI. So instead of using the RSI as a trending type of indicator, I want to maybe make an adjustment to this. If I change this RSI setting to something more standard or more typical, let's go with an 8 RSI. So we've got an 8 RSI, and with an 8 RSI now, we are able to better see overbought and oversold conditions. We can better see buy and sell signals. Now, generally, I don't like the close. I prefer a typical setting with the RSI. But when we have a smoother RSI with a short period, something that is not competing with the moving averages, now we've got an RSI that is telling me different information. Now, with an RSI like this, I don't generally use the RSI for overbought and oversold markets. I generally prefer an RSI for a crossover. We get a crossover of this 50 area. I have a nice idea of a signal. So if I have a trend that is moving down, the RSI crosses above the 50 and then crosses back below the 50 in the trending direction, that to me is a signal that I would like to take. And the RSI is looking at something very unique for that entry criteria. So I want to keep the RSI at this particular setting. So let's remove the RSI just for now and take a look at the stochastic oscillator. I've done a video about the stochastic oscillator showing you a way to identify overbought and oversold conditions. And it turns out that the stochastic oscillator with the settings of 14, 5, and 5 are pretty nice. I don't use the signal line when I have the stochastic oscillator. I don't like the crossovers. They are not timely. They do not give me any information that I want. So I get rid of that signal line. And what I get now is a stochastic oscillator that shows me overbought and oversold market conditions. So when I'm looking at the market for short trades, I want to avoid taking short trades when we're oversold. And when we're looking for buy trades, I want to avoid taking buy trades when the market is overbought. Now, the stochastic oscillator is a great oscillator tool for this. It's giving us a little bit different dimension to the market. It's showing us something that the other indicators are not showing us. We can get an idea of overbought and oversold markets by looking at the moving averages, and we see the price gap from these moving averages. That gives us an idea of what's overbought or oversold, but the stochastic oscillator shows us without a question. There's no doubt by looking at this stochastic oscillator that we are either overbought or oversold. So this is an indicator that we can keep. We can keep this indicator on the chart, and I don't have to make much changes to this indicator. So let's limit this stochastic and let's bring up the MACD. Now, the way the MACD is being used in this case, again, it's a trend following indicator. We'll make the settings 13 and 50, and it is going to mimic this red line and this blue line. So we've got this 13 EMA and the 50 EMA, and what it's doing is showing us that trend. Now we see that trend with the moving averages that are on the chart. We do not need this MACD using it in this way. We use the MACD to show us momentum generally. I presented this MACD to you as a way to identify the trend, but because we are using these moving averages, this is not something that we need. We do not need to identify the trend anymore using this particular setup with the MACD. Now, if I go into the styles, let's take a look at that histogram. Now I'm getting the same information, but we're including momentum. So now with the histogram, I can see the momentum of these market moves. If I've got the histogram in here, I can see that we are losing momentum as this price continues to climb. We're not getting this kind of information from the moving averages. We're not getting this kind of information from the RSI. We're not getting this kind of information from the stochastic oscillator, but we are getting this market momentum uniquely from the MACD. Now with the MACD, again, this blue line shows us a separation between these moving averages. So I don't really need the blue line on the chart. I'm just interested in the market momentum. So if I go back to that MACD and I get rid of the blue line and just keep that histogram, now I've got an indicator that shows me some momentum. Now, if I put all of this together, I've got a momentum indicator. I now have an overbought, oversold indicator. I now have, with the RSI, an indicator that can give me signals. With the moving averages, I have an indicator that can show me the trend. So now with these different indicators, I've gotten rid of the redundancies, and each indicator is giving me some unique information. I know the trend with the moving averages. I know what direction the trend is. I can see that the pullbacks are happening and where those pullbacks are giving us the best opportunities to take a trade. When the market pulls back and gets into those moving averages, I could be looking at that RSI for an entry signal. Now again, this is an 8 typical. Let's go to a 5. This is my preferred setting for the RSI is 5. It's very quick. But when I'm trying to get into a market, I need the most timely indication for that. So now I've got an RSI that is showing me some really nice entry type signals. We've got a downtrend here because of the moving averages. I can see when the RSI pulls up above the 0 line and then back down, that gives us a potential short trade. So now when I'm looking to be taking a trade, I can be looking at the stochastic oscillator and it shows me overbought and oversold conditions. So when we have a stochastic oscillator that is overbought, I don't want to buy. And when we have a stochastic oscillator that is oversold, I don't want to sell. And finally, we've got the MACD down below, and we've gotten rid of certain elements of the MACD, and what's left is market momentum. So I can see when the market momentum is starting to die, and I know that a trade may be very short-lived. So if I do go and I look into an area like this, we've got this swing high in the market followed by a second swing high. We have that initial swing high on the MACD followed by a very low swing high. This shows me that this area in the market may struggle to continue to move up. Now, when you put these indicators together in a way that each indicator does its own thing, you are going to reduce the clutter. You are going to have an efficient trading system. We can break this down into usable chunks. They all serve a purpose. And as a result, your system does become as clean and as simple as possible. Now, even with this system, you may get rid of some of the different aspects. Stochastic oscillator, I know when the market moves away from these moving averages, I'm not interested in taking a trade. I need that price to get into those moving averages before I take a trade. Now, the stochastic oscillator does show us when the price is away from those moving averages. Do I need that stochastic oscillator? Probably not. So I could get rid of that. Now I've got a set of moving averages that gives me a trend. I've got an RSI that could give me a signal. I've got a MACD that shows me momentum. Do I really need the MACD? The MACD might be nice. It might keep me out of trades. For example, if I'm looking at a short trade in here, market has moved down, it's pulled away from these moving averages. Market gets into the moving averages, which is what we ideally want to see. What we're seeing on the MACD is some huge weakness. Sure, we can keep that MACD as long as it's not getting in the way and as long as it's something that you can read. If you're looking at it and you're really not sure what the MACD is saying, get rid of it. But in this case, we have an idea of the market momentum, so this is something we can keep. So what we've done is taking some fairly random looking indicators. We've refined them to produce a tradable and effective trading system. Every indicator has a job to do. And as long as we know what that job is and we can keep everything within the context of the market, you'll find that this is a profitable trading system. If you like this video, please give it a like. And if you haven't subscribed, please do that as well. It really does help me out. I want to say thank you for watching this video. And if I don't see you in the UBFX members area, I will see you in the next video.